Good morning to all. Today we'll see about the macroeconomics. So macroeconomics means we can consider as a whole. Okay, first we'll discuss about the aggregate demand. So aggregate demand means it is a summation of demand for consumer goods and then capital goods. And aggregate supply means it may be a summation of supply of consumer goods and capital goods. So first we understand the stock and flow. Stock means it is economic variable which has been accumulated at a specific point of time. For example, money, asset and wealth. Flow which may increase and decrease the stock over a period of time. It's like investment, savings, consumptions. So these are the examples for flow. The stock which may be defined as the difference between and inflows and outflows. So first of all we should understand the difference between intermediate and final goods. Intermediate goods means which is also known as partially finished goods or raw materials which may be uh, used for producing some other goods under utility. And then final goods means which may be demanded by the final consumer, that is known as final goods. Next, we can discuss about the some macroeconomic variables, capital formations. So it is the process of savings being converted into investment, that is known as capital formation. Employment means a person is willing and capable to work in a productive activity, and he is engaged for certain number of hours per week for self or someone else. And there are government expenditure which is made from public exchequer. Government revenue means the income which can be received by the government, like taxes. There are several taxes are there, direct and indirect taxes. So income tax, capital gains tax, securities transaction tax, these are the direct taxes. Sales tax, service tax, value added tax, etc. is indirect taxes. And other taxes like proportional tax, toll tax, gift tax, and then entry tax, municipal tax, which is also considered. So next we'll discuss about the national income. National income, it may be defined as the money value of all the final services and goods in a economy. So there are several concepts are there, that is GDP, gross domestic product. GNP means gross national product, and then NDP means net domestic product, and NNP means net national products and per capita income. We will see one by one. Gross domestic product means it is the summation of C plus I plus C plus X minus M. So that is the sum of money values in the country, that is inside the country, that is the summation of consumption, investment, government expenditure, and then difference of imports and exports. So then in GDP at market prices, in this consideration we include the indirect taxes and exclude the subsidies given by the government. And then GDP at factor costs which may be exclude the indirect taxes and include the subsidies also. Next we'll discuss about the real and nominal income. Real income means there is it may be calculated based on year and has a fixed price. It is known as real national income or national income at constant prices. National nominal income is there is it may be estimated based on the prevailing price, that is known as national income or nominal national income or money national income. Okay, so here we can discuss about the real GDP. The real GDP means it is the ratio between nominal GDP and GDP deflator. Next we will discuss about the gross national product. Gross national product, it may be aggregate final output of citizen and business of an economy in a year. So GNP is the summation of GDP plus NFIA. NFIA means net factor income from abroad. And then net domestic product, it is the, we can consider about the depreciation, that is difference of GDP and depreciation. Net national product, it is the difference between GNP and depreciation. And then next NNP at market price, here we can include we can exclude the depreciation, and the NNP and factor cost we can include the subsidies and exclude the indirect taxes also. So this is the final one, that is GDP means C plus I plus G plus X minus M. C means consumption, I means investment, G means government expenditures, X and M are import and exports. G and P means GN, that is GDP plus NFIR, and NDP means GDP minus depreciation, NNP means GNP minus depreciation. So next, per capita income, it is the ratio between national income to the total population in the year. So the personal income may be calculated based on the taxes, social security contributions, undistributed corporate profits, it may be excluded, and corporate taxes also excluded, and we can include the interest on public debt, and the personal disposal income, it may be difference of personal income and the personal taxes. So next we can discuss about the methods of measuring national income. There are three methods to be there. First one, product method, and then income method, and third one, expenditure method. In product method there are two types: final product and value added method. So in product method, that is also known as output method, it may be goods and services produced in a country by the firms and across all industries added up together. So the market value to be added here. So first of all, we can the physical unit of output are interpreted in a money terms. That is the GDP at market prices to be added, and indirect taxes are subtracted and the subsidies are added. And then net value is calculating is subtracting the depreciation from the total value. So there are some limitations. There may be problem of double counting, not applicable to territory or service factor, and exclusion of non-market products may be opportunity cost items, and self consumption of outputs. So income method, we have GDP at factor cost, and GNP and factor cost may be included, and then we can economy may be divided on the basis of income group such as salaries and rent and profit, and then all group are added including income from the abroad and undistributed profits. Maybe we can add rent, wages, interest and profit, and net income from the abroad, and we can exclude the transfer payments. So there are some limitations of income method. So exclusion of non-monetary income, and then exclusion of non-market prices may be there. And expenditure method of measuring national income, the total expenditure incurred by the society in a particular year is added. So there are several components, that is personal consumption, net domestic investment, and government expenditure on goods and services, net foreign investments are there. There are some limitations. It ignores the border systems, so there is no change in product and services, and ignores the own consumption and affected by inflation.